Every single housing crash in history, from the 1980s to the early 2000s to the 2008 meltdown, all started with the exact same warning signs. And here's the scary part. Those signs are flashing again right now. Home buyers don't see it. Sellers don't want to believe it. And the media, they'll tell you everything's fine. It's too late. But if you know what to watch for, you'll see the storm coming before everyone else. Set the stage. Think back to 2008. People thought home prices could never fall. Everyone was buying at the peak, fueled by FOMO and easy credit. And then the bottom fell out. Millions lost their homes, banks collapsed, and trillions in wealth vanished. Fast forward to today, 2025, and I'm seeing the same patterns forming. Not in theory, not in headlines, but in hard data and in real neighborhoods across America. What's coming up? In this video, we're going to break down the exact triggers that always show up before a crash, why they're happening again now, and what this means for you, whether you're buying, selling, or investing. By the end, you'll know how to spot the danger signs most people miss and how to protect yourself when the market finally tips over. So stay tuned, grab a coffee, and let us dive deep into what always happens before real estate crashes and why it's starting again right now. And don't forget, if you want to stay ahead of the curve, hit that subscribe button and join us here at the Real Estate Scout. The psychology before a crash: overconfidence. Every crash begins with the same dangerous mindset. This time is different. People convince themselves that prices can only go up. They say it's not like 2008. Demand is too strong. There's no way the market will crash. But history proves otherwise. That same confidence existed before every single housing downturn, FOMO and bidding wars. Right now, families are still jumping into the market, outbidding each other, stretching beyond their budgets because they're afraid of being left behind. We've seen stories of buyers waiving inspections, offering $50,000 or $100,000 over asking just to secure a home. That's not a sign of a healthy market shit. That's a sign of panic buying fueled by fear of missing out. Media reinforcement. In fueling that psychology, the media headlines saying, "Housing market remains strong" or "soft landing expected." Those exact words were used in 2006 and 2007. People believed them, and it cost many their homes and life savings. The media often paints a rosy picture until the crash is already here. Real-life case example. Take the Johnson family in Phoenix, for example. They bought a brand new home in late 2024, thinking prices would keep soaring. They stretched their budget, locked in at a high interest rate. And now, less than a year later, homes in their neighborhood are selling for tens of thousands less. They're underwater before even celebrating their first anniversary in the house. This story isn't rare, it's becoming more common. This is the dangerous psychology before every crash. Overconfidence, FOMO, and blind trust in headlines. But psychology is only the surface. The real cracks always show up in the numbers: first mortgage rates, affordability, inventory, and investor behavior. And right now, those numbers are screaming warning signs. Key economic warning signs: rising mortgage rates and affordability collapse. One of the first cracks that always appears before a housing crash is affordability. And right now, mortgage rates have climbed so high that the average American family simply can't afford the average home. In fact, the monthly payment on a typical house is now almost double what it was just a few years ago. When people are priced out, demand collapses, and that's the spark that often lights the fire. Prices detached from wages. Another clear warning sign. Home prices have completely detached from incomes. Historically, homes sell for about 3 to 4 times the average household income. But in many cities today, we're seeing ratios of 7, 8, even 10 times the average salary. That math doesn't work forever, and wages can't keep up. The bubble always bursts. Inventory suddenly spiking. Next is inventory. In healthy markets, supply and demand move together. But what we're seeing now is a sudden surge in listings. Sellers are rushing to cash out while they still can, and homes are sitting longer and longer on the market. This is exactly what happened in 2006. Inventory piled up quietly for months before the crash made headlines. Builders cutting prices and offering incentives. And then there are the builders. Right now, home builders across the country are slashing prices, offering huge incentives like free upgrades, interest rate buy-downs, and even cash bonuses to buyers. When builders start panicking, that's a massive red flag. They have insider knowledge of where the market is headed, and they're acting fast to unload inventory. Historical parallels. Here's the scary part. These are the exact same signs that appeared before every major housing crash in history. Rising rates, stretched affordability, overinflated prices, and inventory spikes. If you line up today's charts next to 2006, the patterns look nearly identical. So if the numbers are already screaming danger, what comes next? The behavior of investors and landlords, the people who bought up thousands of homes during the boom starts to shift, and when their psychology flips from greed to fear, that's when the market really unravels. Investor behavior shift. Institutional investors pulling back. Another key sign before every real estate crash is the shift in investor behavior. For the last few years, big institutional investors, hedge funds, Wall Street firms, private equity groups were buying homes like crazy, outbidding regular families. But now, they're pulling back. Many of these firms have already paused new purchases or are quietly selling off properties. Why? Because they see the math doesn't work anymore. High rates plus high prices equals shrinking profits. And trust me, these firms don't wait around to take losses, they exit early. Short-term rentals in trouble, Airbnb bust. Then there's the short-term rental market. During the boom, thousands of people rushed to turn homes into Airbnbs, expecting endless streams of vacationers. But now, oversupply and falling demand are crushing those owners. Occupancy rates are dropping, nightly rates are falling, and many hosts can't cover their mortgages. We're already seeing Airbnb investors dumping properties at discounts just to escape the debt, flippers getting stuck. And what about house flippers? The people who bought homes to renovate and sell for quick profits are now stuck. Homes are sitting longer on the market, renovations are more expensive, and buyers are disappearing. Some flippers are being forced to sell at a loss or worse. Hold on to multiple properties with mortgages they can't afford. This exact domino effect took down thousands of investors in 2008. Rising days on market, the data is already confirming this shift. Homes are sitting longer. What used to sell in days is now sitting for weeks or months. Rising days on market is one of the clearest indicators that demand has dried up, and that investors are no longer confident. Once they start panic selling, prices don't just dip, they fall off a cliff. And when investors pull back, banks and lenders start to notice. Credit tightens, foreclosures rise, and the financial side of the housing market begins to crack. And that's exactly what we're starting to see right now. The banking and lending side. Banks tightening credit. When investors and regular buyers start pulling back, banks notice. History shows that before every crash, lenders slam the brakes. Right now, we're already seeing stricter lending standards, higher credit score requirements, lower loan approvals, and fewer first-time buyers getting qualified. That tightening chokes demand even further, accelerating the slowdown. It's rising default rates. At the same time, early warning signs are flashing in the loan data. Delinquency and default rates are quietly creeping higher. Families who stretched themselves too thin during the peak of 2024 are starting to miss payments. And if history is any guide, this is the canary in the coal mine for a bigger wave of foreclosures. Adjustable rate mortgages resetting, and here's a dangerous echo of the past. Adjustable rate mortgages. Thousands of homeowners locked into teaser rates that are now resetting much higher. A family who could barely afford a $2,000 monthly payment is suddenly staring at $3,000 or more. That's not sustainable, and it's exactly what fueled the foreclosure crisis in 2008. The domino effect of foreclosures. Once foreclosures begin rising, they create a vicious cycle. Banks flood the market with discounted homes, which pushes prices down. Regular sellers then cut prices to compete. That ripple spreads city by city until the entire market feels the pain. This is the financial side of the housing crash most people overlook. But here at the Real Estate Scouts, we dig deeper to uncover the patterns and warning signs the mainstream media ignores. And the next big clue is already showing up in specific U.S. cities where the cracks are turning into collapses. Regional hotspots showing cracks. Cracks always start somewhere first. Every housing crash doesn't start everywhere at once. It starts in specific hotspots and then spreads. Just like in 2006, some cities are already showing the early cracks. If you want to know where the storm hits first, you need to look at these markets. The Sunbelt cooling fast. Take the Sunbelt places like Texas, Florida, and Arizona. These states saw explosive growth during the pandemic as buyers rushed in for cheaper homes in warmer weather. But now, inventory is spiking, price cuts are piling up, and homes that used to sell in days are sitting for months. Builders in Dallas, Austin, and Tampa are offering massive incentives just to move properties. That's not strength, that's weakness. West Coast tech hubs struggling. On the West Coast, the tech slowdown is hitting housing hard. San Francisco, Seattle, and parts of California are seeing layoffs ripple into the market. When incomes fall and demand dries up, even million-dollar homes start getting price slashed. These were some of the hottest markets in the boom, and they're often the first to feel the bust. Overbuilt markets cracking. Then there are overbuilt areas. Cities that added to many new homes and apartments during the boom, like Las Vegas and Phoenix, are facing oversupply. When too many homes hit the market at once, prices can only go one direction down. Data already shows the slide. The numbers don't lie in some of these cities. Price cuts are happening on nearly 30% of active listings. That's huge. And remember, these markets are the canaries in the coal mine. The pain always starts at the edges before it spreads nationwide. So whether it's the Sun Belt, the West Coast, or overbuilt boomtowns, the story is the same: cracks are turning into collapses. And if history repeats itself, this is only the beginning. Up next, we'll break down exactly what happens after these cracks spread, and how the cycle accelerates into a full-blown crash. You're watching the Real Estate Scouts. Let's keep going. What happens next? Price reductions accelerate. When cracks in the housing market widen, the first thing you see is a wave of price reductions. Sellers who once thought they could get top dollar are suddenly chasing the market down. A home listed at $500,000 drops to $475,000. Sellers panic, buyers disappear. As the cuts stack up, sellers panic. Families who stretched their budgets to buy during the peak start to worry they'll lose everything if they don't sell now. Investors who bought at inflated prices rush to unload properties. Meanwhile, buyers disappear. They'd rather sit on the sidelines than risk buying at the top of a collapsing market. Media shifts tone. And this is when the media finally flips the narrative. For months, they've been pushing headlines about a so-called soft landing. But suddenly, those headlines change too. Housing market weakens. Is a crash coming? And then finally, housing market in free fall. By the time the media admits what's happening, the crash is already well underway. Panic selling phase. This stage is the panic selling phase. It's when homes hit the market in waves, prices spiral downward. And people who thought housing only went up start realizing the truth: markets can and do crash. And once fear takes hold, it spreads like wildfire. Transition with branding. That's the natural sequence: price cuts, panic, and a shift in the narrative. But here's the real question. How do you protect yourself when this happens, and even position yourself for opportunity? That's what we'll cover next. You're watching the Real Estate Scout. What buyers and investors should do. Don't rush in. If you take away one thing from this video, let it be this. Do not rush into buying at the peak of the market. Approaches punish impatience. Instead of chasing overpriced homes, step back, watch the trends, and be ready when opportunities appear. Build cash reserves. Cash is power in a downturn. Families with savings and investors with reserves will have the flexibility to buy when everyone else is forced to sell. In every crash, wealth transfers from the unprepared to the prepared. Make sure you're on the right side of that equation. Focus on fundamentals. Focus on what actually matters: steady income, job security, and affordability. Don't get caught up in the hype of bidding wars or media headlines. Stick to the basics, and you'll not only survive a housing downturn, you'll thrive in it. And remember, every crash creates winners and losers. The losers panic and overpay. The winners stay patient, informed, and strategic. If you want to be among the winners, keep watching, keep learning, and make sure you hit that subscribe button. You're rewatching the Real Estate Scout, and we LLB here to guide you through every step of the housing cycle.